Hey everyone and welcome back. Today's video, of course, is the final episode of Stock Market Q&A for 2019. We're at December. We finally made it. And I'm very impressed with myself that I only missed one. I missed one Q&A video this year. Maybe we'll do better next year and we'll get all 12 out. But as always, I made a post on the community board prior to making this video. And for this particular video, there was a lot of questions. So I'm so sorry if I don't get to answer your question in this video, but essentially I'll go through and answer as many as I can squeeze into a 15-minute video. And then some of the questions that I don't answer, myself and Brandon will answer some of them on our final episode for the year of the Young Investors podcast. So if you're not aware, myself and Brandon from the Aussie Wealth Creation YouTube channel, we do a podcast every week. It's an hour long and we basically go through the news stories for the week. We talk about and break down some particular investing topic. And then finally, we answer some questions from you guys, from the viewers. So if you left a question on the community board, it might be answered in this video, but it also might be answered on our final episode for the year, our end of year edition of the Young Investors podcast. But without further ado, if you do enjoy today's video, make sure you go ahead and leave a like or let me know what your thoughts are down in the comment section below. But for now, let's get into it. The first question we've got here today is, hi Hamish, you made an investment. What happens next? How do you keep track of your investments? What records do you keep? What about reviewing and rebalancing your portfolio? Do you do this and how do you go about it? Okay, so once I make an investment, the first thing that I do is that I enter in all of the details into a software, a website called Sharesight. And full disclosure, I am affiliated. I do work with Sharesight. So you can check out the link in the description below for my full review and the best deal that you can get on signing up if you're interested. But I don't just talk about it because I'm just promoting it and because I'm making money. I talk about it because I've actually been using it for the past 3 years and it's been the best thing that I've ever found for doing what I need it to do, which is to track my performance of my returns and that sort of thing, as well as make tax time really easily. So the first thing that I do is I enter in the new stock into that so that I can add it to my running portfolio that's in there. In terms of sort of, I guess, keeping track of my investments, because I'm a long-term investor, I'm not doing a lot of sort of, I guess, day-to-day work in trading or anything like that. For the most part, I'm just looking to keep up with news that's happening. Every week, I'll check if anything major happens. If anything major happens with one of my investments, I'll know about it because I don't have many investments, so it's very easy for me to find the news stories that come up about those businesses. But for the most part, nothing happens. Quarterly report comes out, I have a look at it, make sure things are still on track. If there's any problems, I sort of analyze it and critically work out whether or not it's a short-term or a long-term problem. And then what was the other part of your question? Reviewing and rebalancing. Well, my rebalancing is entirely based on valuation. So if a business is cheap and it's not already 20-25% of my portfolio, then I'm going to be adding to that consistently until it reaches 20-25% of my portfolio. That's kind of my limit as how much I want in an individual business. In terms of reducing positions, I only really reduce positions if their price is exceptionally high. For the most part, I'm looking to be a buy and hold, so I don't really do too much sort of portfolio movement around. I'm not trading in and out of stocks to make all the percentages look really nice. It's just a matter of whether the business is cheap or not. If it's cheap, I'll buy it. If it's in the middle, I'll do nothing. And if it's really expensive, I might start to sell some of that position. The next question we've got here is, howdy Hamish, I'd love to know how you determine whether the CEO's compensation is in line with shareholder interests. With different sized companies, salaries, bonuses, options, etc., I find it hard to work out for myself whether their compensation is justified or not. Thanks. This is an excellent question, and I think this is probably one of the most difficult parts of analyzing a business. It's certainly a part that I find very confusing as well, so you're not alone in sort of being confused about how compensation works. So in terms of CEO compensation itself, there's really three main ways that they receive money. One is salary, so that's just a base salary. I'm sure everyone's familiar with what that is. The second is performance-based stock units, or stock awards, it's sometimes called. And this is where if the management team, if the company hits certain key metrics, maybe it's earnings per share growth or revenue growth or something like that, then they will receive stock as compensation. And then the final compensation that's most common is stock options, which is where they get the option to buy a stock at a certain price. So if they push the stock price up to a certain point, they can exercise that option, buy it cheaper than it currently is on the market, and then sell it on the market. But really, what I'm most importantly looking at is really two things. One is how much of the company do they own as a percentage of their wealth. So if they're a billionaire, if they're very sort of, I guess, a famous person, then you can sort of you can go on Google and you can find out how much they're worth, and you can compare that to how much money is in that particular stock. So, for example, Mark Zuckerberg, he's a billionaire, multi-billionaire, worth $60-70 billion, but most of his money is in Facebook. We know this, right? Because we know how much Facebook stock he has. We look at the proxy forms and we know what his overall net worth is. So that's a good situation where most of his net worth is invested in the company. So that's the first thing I look for. And then the second thing I'm looking at is not only just the compensation that the manager is receiving, but what is the behavior that they're doing with their compensation. So, for example, some CEOs will receive a lot of stock in options and awards. And at first glance, that seems not very good for the shareholders, because it means that every time they receive those stock options and stock awards, your shares get diluted, right? Because it cuts the pie into more pieces. But what I care about more is whether they're holding on to those options or whether they're selling them immediately. If the CEO is just receiving a ton of stock options and a ton of stock awards and is consistently selling them to get cash, then that means that their values are not aligned with ours. We want a CEO who, if they're receiving compensation in the form of stock, should be holding onto that and building their position, because that shows us that their values, they believe in the long term of the company, and that their values are therefore aligned with the long-term shareholder. The next question we've got here is, what is your goal for 2020? Have a marvelous day, Hamish. So he's talking about goal in terms of capital, YouTube subscribers, YouTube views. I want to hear all the goals. I actually haven't done my goal setting for next year yet. It's something that I do in the last 2 weeks of the year. So over Christmas, New Year's time. So I'm going to be doing that very soon. But I mean, I guess in terms of goals, I'm sort of thinking about, at the moment, I'm trying to work out whether sort of the types of goals that I want to be setting. So in the previous year, I set income goals, so profit goals basically for my business, which was how much revenue I wanted to make, minus, keeping expenses as low as possible, and then generating as much profit as possible. And I hit my revenue goals, my profit goals, I should say, by a landslide, and I was really happy about that. But at the same time, I realized that profit really isn't something that I really care about right now. In terms of the business, I want to see the business grow as much as possible in the future, and as a result, I should be focused on top line growth, but I should be reinvesting as much as possible in order to compound my business. And this is kind of a parallel between my personal business and investing, is that I was trying to maximize profits and sort of, I guess, return it to shareholders, which was just me. But then it was just sitting in my bank account, which is kind of useless. I would rather reinvest it back into the business, because there's obviously tons of opportunities for me to do that. I'd rather reinvest back into the business next year and try and compound the business as much as possible. And one of the key metrics that I'm looking to use as a measure of how well my business is doing is the feedback that I get from my clients, from my students. That's something that I haven't made a focus, or what it really wasn't a focus in 2019. Of course, I cared about how well the students were doing, but it wasn't sort of a metric that I was striving towards. And I think that's going to be one of my major goals going into next year, is making sure that I'm focused on the students as much as possible and seeing that they're happy with their results and what results that they're getting. The next question we have here is, hi Hamish, what are the differences between your style of investing and Mohnish, Pabrai, and Warren Buffett? That's a good question. I think I think Mohnish Pabrai leans a little bit more on the value side compared to growth. So both Warren Buffett and Mohnish Pabrai combine value and growth. It's kind of like a blend method where you're looking for companies that are cheap compared to their cash flows, but you're looking at companies that also have the potential to grow in the future, to compound. And I think Mohnish leans more on the value side. He's looking for dirt cheap value in companies, and he doesn't look so much for companies that are going to be compounders, as Mohnish would call them. Whereas Warren Buffett these days leans much more on companies that are really, really great companies, and he's willing to pay up a little bit to get those companies. He's not really looking for deep, deep value anymore. He might have been in the past with his cigar butt investing style, but now he's really looking at big brand companies that are going to be compounders into the future. And I think I align myself a little bit more with Warren Buffett in that case. I'm looking for big brand companies with great management teams, and I'm looking to project their growth into the future. I'm still expecting growth out of them, so therefore I'm not buying them as cheap as Mohnish might, but I'm buying into better companies, greater companies that have a much stronger chance of being compounders over the long term. The next question that we've got here is which red flags show that a stock is a bad investment? There are a lot of red flags. To name a few of the major ones would be really high debt relative to equity. So the two metrics I look for in terms of debt are the current ratio. You can give it a Google search. It's very easy. And the debt to equity ratio. And then also interest coverage ratios with cash flow. So looking at cash flow compared to interest payments. Those are some of the major ones that I look at in terms of debt. What else have we got? We've got a CEO who is selling stock. So this relates back to the compensation question. If you have a CEO who's selling a lot of their stock, that's a terrible sign. And the worst situation is where a management team is taking on debt to repurchase shares, but they themselves personally are selling the stock. That's a very funny position that I find too many companies in. Is that the CEO obviously believes that the company is, well, he must believe that it's undervalued if he's using company money to repurchase stock, right? He wouldn't just be propping up the stock price for no reason. But then he kind of contradicts himself by not buying the stock himself. So I kind of lumped that in with debt, but really the core of that is a manager personally doing the same actions as what he is doing with shareholder money, which is the company's money. Often you'll see a CEO, they're launching big buyback programs, shooting up the stock price, but in their personal portfolio, they're offloading stock. And that seems weird to me. If the stock's undervalued, not only would you want to buy it with company money, you'd want to buy it with your own personal money. So I guess that's kind of a couple of red flags that I would look for. The next question we've got here is, what books would you suggest to a new investor? One of the best books that I would suggest if you are wanting to follow the strategy that I'm teaching here is books by Phil Town. So Rule 1 Investor, Rule 1 Investing, I think it is, and Payback Time. And then there's one called Invested, which he collaborated with his daughter. All of those books are very good. The one catch is that when you're reading it, don't fall into the trap of sort of thinking that investing is super easy, because Phil makes it seem as though it's so easy that you just chuck in these formula numbers and bam, here's the greatest stock and you buy it and you're a genius. It's very, very basic, the book, so it's a good foundation, but you need to understand that it goes much deeper than the formulas and the very basic calculations that he talks about in that book. But if you're interested in the strategy that I teach, and especially if you're interested in enrolling in Learn by Example, which is my program that I help a small group of students, if you're interested in enrolling in that next year, then reading Phil Town's books is the perfect foundation so that you understand the core of what we're teaching, and then you can dive into my stuff, which is a little bit more complicated for people who understand the basics and have been investing for a little while. And the final question that we've got time for here is, as I'm going into university, how much money should I put in my portfolio if I don't have a source of consistent income while I'm in school? So the first thing that I would say is that it's completely fine to not have a consistent source of income if you're at university. I know how hard it can be for some courses to juggle doing the coursework and attending classes, lectures, as well as having a job as well. So I completely appreciate your situation. But the answer to your question is whatever you can afford to forego in the future. So if any money that you don't need for the next 10 years, put it away. And that can be a hard decision to make, because obviously it's very hard to know what money you're going to need over the next 10 years. But what you need to understand is that you're going to university for the next probably 3-4 years maybe, and then you're going to be getting a full-time job that is going to generate a lot of income for you, or it should generate a lot of income for you, and that is going to be able to pay for most of the ongoing expenses, or all of the ongoing expenses actually, that you have. Right now, as a student, you really don't have that much need for capital, in most circumstances at least. Of course, I'm generalizing, so don't crucify me. I'm not talking about everyone. But in most circumstances, you don't have a need for a lot of disposable income. And as a result, you find that there's a lot of students that just have, I don't know, a couple of grand, or like $5,000 or $10,000 just sitting in an account, really doing nothing. And that is the kind of money that you would want, that I would, in my circumstance at least, I would move that into an investment and leave it, let it compound for 10, 20, 30 years in an index fund or individual businesses, if that's the way that you want to go. But really the answer to the question is any money that you don't need over the next 10 years. I think that, any money that you don't need over the next 10 years, and just be careful that as a student, you might think that you need more now than you actually do. So you can put more away than you think. And any money that you put away will be very, very beneficial to you over the next 10, 20 years and over the long term. So that's all we had time for today, guys. And thanks everyone for asking questions. Again, I apologize if I missed your question. But as I said in the beginning, me and Brandon are going to be grabbing an extra couple of those questions and answering them in our final episode of the Young Investors podcast, which comes out on Saturday this week, I believe. I'm not sure when this video is going out, so that might be wrong. It might be already out, but the last episode for the year of the Young Investors podcast, some of those questions will be answered there. But thanks everyone for joining us today, and we'll be back next year with Stock Market Q&A of January 2020, the first one of the decade. All right, guys. See you later.